My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Cramer. Welcome to Mad Money. Welcome to Harvard Business School. Other people make friends. I'm just trying to make you a little bit of money. My job not just to entertain, but to educate you, teach you. So call me at 1-800-743-CNBC or tweet me, Jim Cramer. I know. I'm not where you were expecting me to be back at my old stomping grounds tonight. I'm at Harvard. But sometimes you get one of these opportunities, a chance to return to your alma mater, this time to interview one of the greatest executives of our time. The legendary Larry Culp, the architect of the resurrection of General Electric, and now the chairman and CEO of GE Aerospace. You got to do it. We arrived here on a day full of cross currents. A big win for a slate of Democrats last night. Big bounce after a disappointing session yesterday. Dow gaining 223 points. S&P jumping 0.37%. NASDAQ pole vaulting 0.65%. Kind of a classic rebound. A reminder once again that we all too often celebrate those who got it right for a day, betting against tremendous companies, instead of celebrating those who got it right by owning and hitching their star to long-term winners and making big money through the power of compounding. You know what? That's what this show is really about. Come to think of it, that's what my career is about. Trying to change people's lives by helping them try to make money without taking on too much risk. I say it's about how to make money in any market in my book. But what I mean is that you can make money in any market provided you realize that disciplined growth investing is the way to go. You just need to practice it unemotionally, consistently, endlessly, and implacably with persistence. Now, I learned those values here at Harvard, across the Charles River at college and law school. When we started Mad Money way back in 2005, we wanted to do a college tour. I dutifully asked Harvard College and was summarily rejected, as we were from dozens of schools. The law school knew how to handle alumni, though, and after a nice contribution, we got the use of a hall there. You know what? This is different. This time I didn't have to invite myself. This time we were invited by GE Aerospace CEO Larry Culp, a former lecturer here, to give a talk. And yes, put on the show. And you know, how could I say no to that? With this CEO, with these kids? As I roamed the campus earlier today, I bumped into a terrific student anxious to attend our show. He said he was so thrilled to meet me because I'd made it acceptable for people to own individual stocks again. Of course, that's giving me way too much credit. I have no illusions. Many forces conspired to make stock picking acceptable once again. I was a good conduit to them. Hence, what I call the Meet the Millionaire CNBC Investing Club show we did with Jensen Huang, who runs a nearly $5 trillion company, NVIDIA, that more individuals seem to have bought than hedge funds. I celebrate Jensen, but more importantly, I celebrate those intrepid souls who stuck with NVIDIA, despite the fear-mongering money managers who spent the better part of a decade doubting what Jensen's created. Which brings me back to the vicissitudes of this market and what it takes to be a good investor. First, you have to be willing to trust the market. Sure, you wake up yesterday and you hear about how a great bellwether like Palantir was down a lot after a terrific quarter. Suddenly you're paralyzed. The stock of Palantir, which you may have thought was Palantir 2 months ago, seizes the mental wheel and drives us right into Soldiers Field, where we're rapidly enveloped by nothing but bears. And for once, they have a good record. They're swarming everywhere, mauling us like crazy. We hear from money managers who invested wisely in the past saying that Palantir is the next big short. We cobble together some quotes from banking CEOs, talk about how richly valued the stock market is, even as they love their own stocks. Next thing you know, it feels like we're at a top, and the whole industry screaming at you to get out now. When you pit trust the market against get out now, buy, sell, sell, sell. Well, guess what wins? The fear factor always does. The dripping red futures, red because of Palantir's failed rally after, it takes on a life of its own. What's the best course of action when you have days like yesterday? Let me tell you what I like to do. The first thing I do is I try to find a stock I like. Perhaps one that just reported, maybe one that reported an amazing quarter, but saw its share price obliterated because of Palantir. How about a stock like Shopify? Why pick this one? This internet behind-the-scenes player? Because I've done the homework, that's why. More specifically, I was able to get into this market's kitchen and see how the sausage was made, and I didn't like it. Shopify is a big company, and its stock, like so many others, trades with the futures, even though it's Canadian. That's why the stock started going down hard. It was just right in line with Palantir, as if there was something truly wrong with this company, the cash flow, the sales, the earnings, the outlook. These are the kinds of things that I'm asking the company's president, Harley Finkelstein, while he's on Squawk on the Street. I'm interviewing why the stock's in free fall. I recall 6 months ago the exact same objections, the exact same pack of lies. I said, don't believe him. It's at $100. Stock's up 60 since then. It was a bogus rap then, bogus rap now. Harley's expecting a very strong holiday season, despite what you might have read in any press story. See, it was time to buy Shopify, not sell it. Or how about a stock like McDonald's? Headlines come out this morning. They say it's a big disappointment, a huge disappointment. It was a big miss on revenues, big miss on earnings. Red ink, well, it made it look like the stock had to go lower, right? But what if the red ink is wrong? What if it was just one more trick of the index sellers? All restaurants have been challenged during this period. What matters is how they respond to the darn challenge. McDonald's, unlike so many other chains that lack the scale and the strength, is lowering prices, lowering them dramatically, and it's working. The other guys keep hoping customers will just get wealthier, come back. They don't want to admit that they're taking prices way too high, to levels where the consumer's too cash-strapped to afford them because they didn't want to miss their quarter. And they're missing their quarters big now. That's what we were looking at. I said before the market opened, you got to buy McDonald's because it understands what our customers in our country and the world are going through right now. There's been too much inflation. So what they did, they cut prices. That's what they did. And even though the market was bad, this stock finished up big. Why? Because the next quarter's got the $5 sausage, egg, and cheese, McMuffin, coffee, and a tater. That's like the old days, $5. That's what matters. So the bottom line, I trust the market. If you trust the market, if you don't believe that one stock controls the entire tape, if you don't take counsel of your fears and you do take counsel of your opportunities, a day like yesterday can be the way you finally get a chance to start wading in. Not all at once. That's for fools, but gradually. As we saw today, yesterday was a good time to start buying. And even if you missed it, I hope you'll keep this experience in mind the next time the averages get hammered. Let's take some questions from Harvard Business School. Hi.
Hi, Jim. Kaylee from Illinois here. Thanks so much for being here.
Thank you for having me, Kaylee. Appreciate it.
My question is this. With so much of our economic growth and market value concentrated in these big AI and semiconductor stocks, are we essentially unhedged as an economy? What happens if adoption and monetization don't pan out? And are these stocks at this point just momentum plays since valuations have gotten so high?
Okay, well, let's take a look at that. I mean, if they're momentum plays, then why can Meta be at 26 times earnings? Why can Google be at 18 times earnings when we back out the cash? Why can NVIDIA turn out to be around probably 24 times earnings if you look at the future projections? These are stocks that are all below the market multiple. So I don't think that they're that expensive. Even Amazon's multiples come down a lot. And Apple, I think, is going to have a great quarter. So I think that their PE is probably going to be roughly just a little bit above the market multiple. All these companies are actually very big conglomerates. And I know we speak to GE, that's a broken up conglomerate. But I like the companies for what they have, which is different businesses that are firing all cylinders. Do I think that the data center is a problem? I think that OpenAI has spent more money than it has. Until they started spending, I was not crazy. I really like the group. The OpenAI spend is a little too high. But in the end, these are the best companies in the world. They're nation states with good balance sheets. They're not momentum plays. And momentum plays are the companies that you see, I call them Sherwood Forest. The Robinhood plays that are over and over bought again. It's the quantum plays that are the problem. It's the nuclear plays that's the problem. It's the derivative data center plays that's the problem. That's where I worry about. That's what people aren't talking about. That and all the nonsense ETFs that have been put together to play momentum. That's what has to go away. I'd rather be on DraftKings and take a 14 parlay to see 5 tight ends that score touchdowns this weekend. Thank you. Yes.
Hi, Jim. Julian from New York. Thanks for joining us. My question for you is, with M&A markets heating up, what are your top picks in healthcare? Are you more excited about the pharmaceutical companies that will be buyers in this market or the biotech companies that will be sellers?
Well, it's a great question. I mean, look, I think Amgen needs to do something because they've got to broaden the portfolio where they need to be able to tell a little bit better story about some of the things that they have a lot of good medicines, and they had a really good quarter last night. Look, my Chapel Trust owns Bristol. Looks like a mistake because I believed in Cobenfy, which is a pretty good product, but it's not selling well at all. 104 million in scripts last quarter. I do believe that there are very few biotechs that I really want to buy right now because they're so picked over. Look, in the end, there's Eli Lilly and there's everybody else. Thank you. Remember, if you trust the market, you take counsel of your opportunities. A day like yesterday, pretty good buying opportunity. On Mad Money tonight, there have been a few greater corporate breakup stories than GE. I'm sitting down with the bankable CEO of GE itself, Larry Culp, here at his former stopping grounds at Harvard. Find out how he's managed to steer the ship so successfully. Then one of the biggest semiconductor deals was just announced, sending both stocks soaring. I'm finding out about the deal with the CEO of Skyworks Solutions. And Axon fell majorly after earnings. But were the results really worthy of this sell-off? I'm sorting it all out with the company's top brass for a company that I have championed for many years. So stay with Cramer. Very good.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Over the past few years, we've seen one of the greatest value creation stories in history. It's the breakup of the old General Electric into three terrific companies: GE Aerospace, GE Vernova, and GE Healthcare. Aerospace and Vernova, which is the old power business, have practically been printing money. And all of it is thanks to the man right here, Larry Culp, the chairman and CEO of the old General Electric, who orchestrated this breakup and remains as the chairman and CEO of GE Aerospace, a stock that's now up more than 80% for the year. Wow. 7 years ago, before he joined the GE board and subsequently was named CEO of the company, Culp was senior lecturer here at Harvard Business School after a very successful tenure as CEO of Danaher, back when it was arguably the best-run conglomerate in the world. So now that we're back at his old stomping grounds, we got a chance to reflect on his incredible comeback with the man himself, Mr. Culp. Welcome back to Mad Money.
Jim, thank you.
Okay, so Larry, you're teaching, you're on the board, you know the situation is really, really hard. What the hell made you take this job?
Yeah, Jim, I've got a great story there, but maybe before we start, I just want to acknowledge this is a tough day in our industry, in aerospace, given the event last night with the UPS cargo plane in Louisville. Our thoughts are clearly with those that have been most directly affected. Safety is the industry's #1 priority. It's not something that we compete on, so you've got an industry coming together to make sure we take all the lessons from what happened in Louisville yesterday.
And it's important to point out, when you have your priorities, it's always the same: safety, quality, delivery, and cost, and always in that order.
You've been listening. That's exactly right, which
really
is why
I know what it means to you.
I want to just make sure we're focused
And it means
appropriately.
Thank you. Okay, so it's a tough business. There are things that can go wrong. Of course, there were many things wrong financially when you took over. I don't know. I remember when you took over, I questioned it. I said, why would you ever want to do this? But you were willing, you were up to it.
Sure. Well, I was happily retired.
Right.
As you know, thought I would never have another full-time job again, but it was GE. And even though I was on the board, it was a company that I had long respected, studied. We studied here at HBS right back when Welch was CEO. I thought it was at least the industrial challenge of my generation. And it was clearly a company that was important and is important not only to our country, but I would argue the world. You put those three factors together, even though it took me a while to come to the realization that it was something that I should do, that's really how I ended up there.
Well, let's help everybody in the room and people at home. You came in, and these are really tremendous companies, but the balance sheet had to be fixed. And if you hadn't fixed the balance sheet first, the company arguably would have gone under.
Well, those were some dark days back in the fall of 2018, even though the Red Sox across town were winning a World Series. But we were really there looking at probably in excess of $100 billion of debt we really couldn't carry. And at the same time, we were struggling to just get our arms around what we were going to do operationally in support of that obligation.
Well, but then you decided to sell life sciences to your old company. I was critical because that was the future.
That was the future and is a great business in its own right. But at times like the ones we were working through in 18 and 19, we had to focus. We had to prioritize. We had to make some tough decisions. Selling biopharma was one of those. But let's remember, that was for $21 billion much-needed dollars.
Right.
And the check came in literally a week before the world stopped, back in March of 2020.
You were down to $600 million in cash flow.
If we had not seen that through, if we hadn't closed in time, I can't even fathom what would have happened to us in March and April with the pandemic.
Okay, when did you realize that you could have three companies? And I'm going to push back on this when you tell me, because I want people to know what other people were saying about it at the time.
Well, a lot of people were talking about that. And
Right.
certainly, as we've acknowledged through the course of 2018, when I was on the board, we were thinking about a whole host of different computations and permutations. But not having our arms around what we were going to do in terms of free cash flow and earnings really made that an academic argument. We needed to focus on the deleveraging. We needed to focus on core operations and leave for another day those strategic conversations.
But I remember you telling me at lunch, look, I'm going to split off Power. And I said, Power's poorly run. I don't understand the contracts. I don't think you can understand the contracts. I think this thing is better left dead. And you told me no. Is it better to be lucky than good, or did you see something that would have triumphed even if we didn't have the data center?
Well, there were a lot of people who were saying, leave it behind,
Right.
write a check if you can.
Well, you
right?
said it was going to have a good credit rating. I thought that was impossible.
But what I think Scott Stracek, who now runs that business, and the team did was just get back to basics. There was a good bit of inheritance tax to pay off, but day by day, doing what you said a moment ago, focusing on safety,
Right.
quality, delivery, and cost, they got that business back up on its legs. And clearly, as we work through the deleveraging, we're positioned to go out on their own, and now they are benefiting dramatically from their position in support of the AI build-out.
Now, when I look at the conglomerates these days, Danaher's gotten pretty pure play. Vimal Kapoor has now taken Honeywell into pure play.
Right.
DuPont, as of tomorrow, pure play. Okay. RTX, pure play. Is it over, conglomerate? Or is the new conglomerate, which is like Google's, Alphabet's arguably a conglomerate, Amazon's arguably a conglomerate. What about the structure? What is it that some people still are attracted to? And it sure didn't work for GE, did it?
Right. Well, I'd throw the private equity firms in there as well, right?
Right.
I think there are multiple ways to win. We did a lot of things at Danaher over 25 years and created tremendous value along the way. Jim, to me, the lesson here is at the end of the day, what matters most is focus on the customer. And when you're big and when you do a lot of different things, sometimes that focus can come in-house, right? It's all about synergies, perhaps, rather than real value creation in the eyes of customers. That was the operating model that we had at Danaher. That was something that we did here at GE to make sure we were improving core operations, foregoing perhaps some synergies to make sure we were doing all we could at Vernova, healthcare, and aerospace to lead and win in our markets. And that proved, I think, to be critical to the operational change.
Well, let's talk about aerospace, and strictly, again, because of where we are at Harvard Business School. I looked at it and I said, it's good business. I don't think you can make any more engines than you can. I don't think you can make any more money from an engine. I don't even know if you can get more money out of service. At every step of the way, I was wrong. That's a wrong way to view it. You would walk the floor. You would get with management. You realized that there were literally billions of dollars being left on the table.
Well, I think in all three instances, particularly in aerospace, right, we were industry leaders, but there were things that weren't necessarily getting the full attention of our teams. And from a manufacturing perspective, I could see, I first saw this in power, I saw it later at aerospace, there were opportunities for us to be better in terms of shop floor safety, better in terms of quality outputs and yields on the factory floor, and in terms of improving our delivery. And if you do that, what tends to happen along the way, what my friend Jim Collins calls the genius of the and, you get cost, you get productivity benefits. And that's really what was so critical to the emphasis on lean and our lean operating model across GE these last 7 years. And I think you see that bearing fruit not only in aerospace, but in the other two businesses.
When does it end? I looked at last quarter. I couldn't believe when I was speaking to you. I said, oh, my God, how did he get that much more out of it? And you said there's still a lot more to come.
Go back to lean, go back to Toyota, go back to Kaizen, right? This idea of continuous improvement. If we say Jim is not going to get any better, guess what? That's probably a prophecy that will become self-fulfilling. But if we take an honest look in the mirror, see what we did well, see what we could do better, and get after those things that could be improved, over time, the cumulative, the compounding effect there can be pretty significant.
You know, earlier you said that we really couldn't do without GE. GE is national treasure. But we have a different government now. And we have a government that I could argue is nationalistic to the point of wanting to help our companies. We have a government that I think needs a good and wants a good GE for aerospace. What are the interactions like? Because frankly, in a lot of ways, it's pretty good for business.
Well, certainly, given the Trump administration's time thus far in 2025, all of my interactions have really been focused on aerospace. And I think the president and his team have been wildly supportive, not only with respect to opportunities to sell our engines, most frequently on Boeing aircraft, all around the world, but also as we've looked at trade. People have forgotten that U.S. aerospace enjoys a $75 billion annual trade surplus. That's really been a function of zero tariffs across the Atlantic in both directions. So in each of the bilateral agreements, the president and the team were focused on that. You see it in the UK agreement, you see it in the Japan agreement, in the European deal, where we have in those bilaterals a zero for zero tariff regime. And I think that sets America up to continue to lead in aerospace all around the world.
We have a terrific audience here. It's my last question to you, which drives me crazy because I want to talk to you for hours. But any advice to young people who are about to go out in the world?
Well, I think the advice that I gave students in a classroom like this, and what I tell our young folks, be substantive. It's too easy in the age of PowerPoint and social media. I'm going to sound like an old guy here, Jim, to be superficial, even when you don't mean to be. But be substantive in what you do, and I think that's still scarce in the work world today. And as a result, if you can do that, I think you'll do just fine, whatever path you pick.
That's Larry Culp. He's the chairman and CEO of GE Aerospace. GE, one of the greatest executives of our time. Mad Money's back after the break. You may be wondering why we're doing a deep dive on Larry Culp's journey at General Electric, where he orchestrated a three-way breakup, made his shareholders fortunes. After all, this is not Mad Business School, it's Mad Money. So let me tell you why. This morning, when the market was down, my colleagues at Squawk on the Street, David Faber and Carl Quintanilla, were questioning me about whether we just return to the same old growth stocks when we bounce, and more important, why do we do so? I said it's simple. These stocks, I'm speaking of things like the Magnificent Seven, have growth in a market that's actually starved for growth, and growth is what saves you. Growth is what makes you money. Does that mean, David said, that there's nothing else that intrigues me? I said, absolutely not. I'm drawn to companies that are doing new things, innovating, improving, but most companies just aren't doing that. I'm drawn to companies like the one Larry Culp reinvented, the old General Electric, now GE Aerospace. He led an amazing turn, and it produced bountiful gains for anyone who believed. It made you a huge amount of money, a life changer for all who got a piece of it. Most CEOs are content to just keep doing what they've been doing with some tweaks, maybe not much else. Maybe they claim they're into AI. But when they do something major, though, it can be dazzling. What Larry created here, the three huge businesses that could have been, well, nothing if he hadn't taken drastic action, is testament to what you can do if you're a thoughtful, hardworking, driven, big thinker like Larry, the former Harvard Business School senior lecturer who saved one of the most storied companies on earth that was teetering on the precipice when he got there. Sadly, this tale of reinvention doesn't happen very often, but when it does, I celebrate it. For example, I really like what David Joyner's doing with the turnaround at CVS. Value creation there is major, covering the front and back of the store, along with the incredible comeback in health insurance. Ed Breen, maybe his last act, I don't know, at DuPont is endlessly bringing out buried treasure reports tomorrow. Vimal Kapoor is splitting Honeywell into three different companies. Greg Hayes at the old United Technologies, spawning RTX, Otis, Carrier. These CEOs created so much value, the kind of gains we typically only expect from tech. But it's harder than it looks. Think about how difficult it is to turn around a corporate ship that's struggling. Mary Dillon fixed Ulta, making people fortunes. But then she took over Foot Locker, couldn't really pull it off a second time. Elliott Hill is trying his darndest to turn around Nike. Even if it works, it's going to take a long time. Starbucks seems to be turning, but the value being created, not yet evident. So we end up defaulting to groups where the growth never seems to quit. The great build-out of huge warehouses filled with racks of supercomputers. Prosaic, certainly. Almost unrivaled? No, not totally. There are more Larry Culps out there creating wealth away from tech. They're just very darn hard to find. Now, I'm going to keep looking for them, but in the meantime, there's nothing wrong with falling back on big tech and the Magnificent Seven, the only assured growth behemoths in the entire market. Let's take some questions. Iram from Virginia.
Yes, hi. Thanks so much for being here. My dad and I watched you all the time growing up. So
Thank you very much.
It.
Thank you.
My question is, what happens when quantum computing becomes real? What advice would you give to those currently investing in AI infrastructure for quantum computing?
Okay, first, I think there are only two quantums right now that are actually real. One is IBM, and the other is Google. There's a lot of others. We've had D-Wave on. Actually, I'm not saying that they're all joke. Like Rigetti is a joke, or as my friend Downtown Brown said, Rigetti is spaghetti. It's not like that. I do feel that what's happened is that there are a lot of speculative stocks about quantum that are 7, 8, 10 years away. IBM's got something that's going to work in the next year or two. It should impact all the power. That we don't need nearly as much power with quantum. But as Jensen Huang told me multiple times, he'll be in there too. You can't run the quantum without the GPUs. So you can run them side by side. IBM is the inexpensive way. They do have 8 machines that are currently working in quantum. That's the way to play it. Nothing else right now. Okay? Nothing else. Yes.
Hi, Jim. Thanks for being here. My question is, Pfizer is one of the world's most innovative pharma companies, yet its stock price is down more than 50% since its latest peak. It recently announced a deal to acquire Metsera, which is a leading provider of next-generation anti-obesity drugs. And it recently announced a deal with the Trump administration on drug pricing. My question is Pfizer a buy?
No. Pfizer sells at 8 times earnings and will continue to sell at 8 times earnings. I'll give you an example of what Dr. Borla should have done. He should have done a preemptive bid and get that. He needs to go up again slowly. He does not have a growth engine. We're beginning to believe that CGen, which is the old Seattle Genetics acquisition, has not produced the results that we thought. He had an upside surprise in both earnings and revenues, and the stock did not go up. That is what I call an uninvestable situation. Thank you. A corporate turnaround is harder than it looks. That's why you find an exec who can pull it off. You stick with them. Much more Mad Money added, including my suite with Skyworks Solutions. Patience paid off for shareholders of Skyworks and Qorvo after merger was announced. I'm hearing about it with this company's CEO. Then Axon's rallied over 800% in the last 5 years, but sank today after earnings. What gives? I'm turning to the CEO to get the story straight. And, of course, all your calls rapid fire in a Harvard Business School edition of the Lightning Round. So stay with Cramer. Last week, we learned of a big and I think long time coming merger in the semiconductor space. Skyworks Solutions buying Qorvo for $22 billion in cash and stock. In response, something crazy happened. Both stocks rallied more than 5% last Tuesday. Now, normally the arbitrage guys push the stock of the acquirer down, but the market loved the deal so much, Skyworks still rallied. So let's check in with Phil Brace, the president and CEO of Skyworks Solutions, to get a better sense of the quarter and the Qorvo deal. Mr. Brace, welcome to Mad Money.
Thanks, Jim. It's an exciting time to be here, and thanks for having me on. It's a great time for both Skyworks and Qorvo, so happy to be here with you.
Well, I couldn't agree more, Phil. And I think one of the amazing things is when I saw the deal come together, I said, oh, my, this is going to create a powerhouse. But I figured, yeah, because of the arbitrage, yours would be pushed down. It didn't happen. Obviously, the market knows that you need scale, you need heft, and there are competitors overseas who want the business that you have with a lot of the cellular and also automotive. This could make it so that you are the powerhouse that people have to worry about.
You know, I think one thing that really impressed me about both companies together, the companies and the products are much more complementary than I originally thought coming in. I've known Bob at Qorvo for quite some time, and I really thought highly of the company. And when it came in, it was like, wow, this is really complementary. And the combination of the two, and you nailed it when you first, the scale is fantastic with $7.7 billion in revenue, $2.1 billion in EBITDA. And then we get access to a whole new set of markets in defense and aerospace and automotive IoT. I mean, the combination is just fantastic. I couldn't be more excited.
Now, one of the things that I thought was most interesting was I initially said on air, because I've not been following the companies close enough, I thought there was a lot of overlap. That's actually wrong. I mean, you just mentioned complementary, but the truth is you may be able to go and have a larger dollar amount per phone than you have now, which I've always felt is the best way to measure your success.
Yeah, I think one thing that really really became evident to me is the complementary nature of the technology portfolio should give us increased scale, less volatility, more predictability as we go through it, and frankly, the operations side and the factory side should give us more stable gross margins. So on the mobile side, this creates a powerhouse, not just in handsets, but in RF in general, because as I'd like to point out to everybody, the world is connected wirelessly, and that's going to remain true for as far as the eye can see. And then in the non-handset space, we get defense and drones and automotive and all the other things are connected wirelessly. So for me, it's just an incredible opportunity.
Well, one of the things that I think the market got wrong in the last few days was a belief in your conference call that you basically said, look, things are actually getting a little bit less strong as the year went on. I looked at it as being, if we're going to play that game, if we're going to go month to month, we're missing the opportunity here, which is that if you create a company that's lasting, I'm wrong to think about how your largest customer may or may not have a good January. Correct? That's one of the purposes of doing the deal.
Yeah, look, I think from our largest customer's point of view, right, the combined company can spend more on R&D together than we can individually as individual entities. So that's really one. Short-term dynamics, look, we see very strong demand on the handset side. You've seen that with some of the press. We've seen broad demand in our broad-based markets as well. And so we benefited from increased units and mix a little bit that favored us. And so it seemed to be a good quarter with a good guide. So.
But you're confident about $500 million in synergies?
Yeah, I think the synergies are meaningful and actionable. And when you look at synergies compared to other deals of this size, it's right in the center of the wheelhouse. We should be very confident we're delivering those. I think they're going to come mostly from, look at where the overlap is. Think about a lot of the SG&A side systems and stuff like that. And then we've got some things we can do on the factory side as well. So I think the synergies are meaningful, but they're achievable. And, the deal is going to be immediately accretive to our shareholders right out of the gate.
Okay, I was concerned that, and I talked this over with my colleague David Faber, who covers M&A for CNBC, that your answer about China was a little more certain than I would be, in the sense that you said, don't worry about the Chinese regulators, but we know that China's gotten fickle. What kind of assuredness can you give the marketplace that China would most likely not reject this?
Well, it's a good question, Jim. We do get a lot of questions from our investors about that. Let me try and give you some context. First, I feel very well advised. We've got some of the best antitrust advisors on the planet that have done some really recent things. Second off, because of the complementary nature of this, we think that we can actually create better products, and the customer support is really what's enabled that. And we look specifically at China, you mentioned. That's a very competitive market and will continue to be a competitive market. Both Qorvo and I's, our exposure into China has been shrinking over time. We're still going to be focused on the high-end premium space where they think they're going to need our technology. But in general, the customer support's been good, the combination's complementary, and we're going to take a deliberate, methodical approach to get through regulatory. And I think there should be a path here.
Good. I need to hear that. Now, I do want to know, I spend far too much time, like many others, when they analyze your company or Qorvo, focused on cell phones, and don't ask enough about the other question of the other businesses, as if somehow they don't matter. Can you tell me the tenor of how they're doing and how they can grow?
Yeah, that's great. I think you're 100% right. We're way more than just a handset company. You look at our exposure into automotive, into data center, into IoT. Frankly, we've seen good tailwinds through those businesses the last 7 quarters that continued into this quarter. And I think what I'm most excited about the combination is that bringing aerospace and defense, which gives us access to a whole new set of TAMs that we haven't had before. So I kind of stand back and go, the world is connected wirelessly. This is going to be true for as far as the eye can see. And this combination really adds new scale and technology that's going to enable us to capitalize on that far into the future.
All right, one last question. Do you think it's going to create jobs in America, or do you think because there's a combination, we may not be able to generate new jobs?
I think that remains to be seen. My goal is to actually try and increase investment where we can to continue to be competitive. Obviously, when you go through a combination like this, there are going to be some duplications, but we're going to be thoughtful and disciplined how we approach that and make sure we balance getting the right cost structure, but also balancing what we need to do to invest to make sure we deliver competitive solutions for our customers. So there'll be a balance there, Jim.
All right, excellent. That makes a ton of sense. I want to thank Phil Brace, who is the CEO of Skyworks Solutions, a company I've long followed and wanted a merger like this. And here it is. Phil, thank you for coming on the show.
Thanks, Jim. Appreciate it. Talk to you soon.
Mad Money's back in for break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It's time for a very special Harvard Business School edition of the Lightning Round Mad Money. That's where I take the calls from everybody, saving the stock, telling about my buy, sell, so we already know the price. Once I've done, I stamp Bears the Cramer, so you plenty of sound. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Let's go with Rago from Canada. Rago.
Booyah from the Great White North, Jim. My question relates to private equity involvement within healthcare. Earlier this year, KKR took $1 billion stake in Henry Schein and appointed board members from the Heartland Dental deal. In your view, can private equity discipline transform this company, or is this...
They need to, because, they charge too much. But they make a ton of money, and that last quarter is really good. I've got to tell you, I was very surprised. Right in the opening bell yesterday, I looked through the numbers again. I think it's a good stock. You've got a good one there. Let's go to Brianna from California. Brianna.
Hi, my name is Brianna, and I'm from San Francisco.
All right.
If you were an HBS student today, what sector would you bet your career on?
Right now, I know this is going to be it's going to be boring, but I would still go with storage. That's the problem. We just don't have enough storage. So anybody who has it, because I'm talking about storage like derivative, like Lam Research, like KLA, like Applied Materials. Thank you. Yes.
Jim, thanks for being here. Bloom Energy, can the company grow?
Damn it, the Bloom Energy, I was against Bloom for so long, and I kept thinking that it's been 20 years. They've only been public for about 10, but for 20 years they were trying to make a lot of money, and they couldn't. And then, boom, it clicked, and it's going higher. The stuff works. It absolutely works, and it's been remarkable. Thank heaven. They stuck with it. Congratulations to them. Thank you. Yes, Jordan, Tennessee.
Hey, Jim, thanks so much for being here. I wanted to ask you about Tyler Technologies. The company's traded down recently, along with a lot of other application software companies.
I don't like that.
Curious where you see it goes from here.
This is, you're in that sweet spot for the Bears. It's too hard. It's just too hard. Everyone's taking shots at them, and it's still got a 40 PE. Let's hold off, okay? Let's go to Zachary from North Carolina. Zachary.
My question is simple. Is Boeing finally getting their act together?
Yes. The answer is yes. And under 200, I want to buy it. I thought the last quarter was really very good. It had very positive cash flow. The reason why people didn't like was because of the charge that I actually thought everyone knew would come, and the fact that 777 has been pushed back a year. I think you buy Boeing right here and put it away. And I'm talking about buy Boeing in size. Let's go to Ash from Jersey. Ash.
Booyah, Jim. Thanks
Booyah.
for all that you do.
You.
My question's on ticker TSLA. Does it trade like an auto company, or is it the future
No,
of
it's entirely trading as if it's on autonomous drive and on robot, and therefore you got to own it. Look, up another 17 today. I've got to tell you that it's a miracle. When the stock went down to 250, everyone said they hated it, and then it morphed into what we're just talking about. And I think that as long as he wins that shareholder vote and stays, the stock can go up much higher. Let's go to Santiago from New Jersey. Santiago.
Jim, Chipotle has been getting crushed. Where does the stock go from here?
I don't know. I mean, Chipotle, I think, has probably settled down. It's probably going to go down to 23, 24 times earnings. It means it could still break down a little bit more from here. I don't like it. It's too expensive. That's what happened. Not executing well either. I sure wish it would. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
What's happening to the stock of Axon Enterprise, the maker of tasers, police body cameras, whole suite of evidence management software? When Axon reported last night, we got kind of a messy third quarter, and the stock got hammered, down roughly 9%. There's a lot to unpack here, so let's get right to it with Rick Smith, the founder and CEO of Axon. Learn more about what's going on. Mr. Smith, welcome back to Mad Money.
Hey, it's good to be here, Jim.
All right, so Rick, we've known each other for years, and it's the first time I've seen a miss, so to speak, and I just thought we'll go right at it. It had to do with some earnings, I guess, a cost side and tariffs. Can you just explain it to us so that we understand what went wrong? Because it may have been flagged previously, and people were just kind of caught unawares.
Yeah, no, this is far from a miss. We turned in a really strong quarter. And look, I've been doing this 25 years. This is the fifth time we've had a strong quarter, and then the stock drops. I think the thing people may have gotten confused about was GAAP EPS. So we don't guide to GAAP because of our stock compensation, right? We have stock that's tied to the compensation that's tied to the stock price. So the better the stock does, the higher our stock comp goes. So what we guide to is adjusted EBITDA, and we came right in at 25% adjusted EBITDA. And we gave guidance on this year a couple of years ago. It's going to be a $2 billion year. It's lining up to be $2.7 billion. So the thing that I think confused folks was between the stock comp and then the one big beautiful bill changed some of the tax accounting around R&D. And so that showed a GAAP net loss. But if you actually get rid of all the weird GAAP stuff, adjusted EBITDA was 25%. So we're maintaining profitability and still growing our seventh consecutive quarter over 30%.
Okay, I want to be sure, though. You did say the tariffs would have an impact on the supply chain. That was on the May 7th call when we spoke last. And I want to be sure that that's not a serious hit to earnings, because a lot of people were confusing the $1.17 versus $1.52 as a problem with tariff. I want to take that off the table if I can.
Yeah, you can. We still hit our numbers. Now, we said that margins were less high than they would have otherwise been, but the adjusted EBITDA number still came in right where we said it would. So we're able to absorb that and still hit our operating numbers.
Okay, so talk about these acquisitions, particularly the 9/11 acquisition, which I thought made a ton of sense, but some people were saying represented older technology. Again, I didn't understand the objection, but let's have you tell people why this is a good acquisition.
Yeah, so let's take a step back. Last year, 240 million phone calls were made to 911, and a 911 phone call comes in on a technology stack right out of the 1970s, right? You could be doing this on a rotary phone, and 911 has no way to take video feeds, location feeds, et cetera. So we acquired a company called Prepared 911 that has the most modern technology stack for taking 911 calls. We can layer in an AI agent that helps the human operator so that we can do real-time translation. We can help keep real-time summaries. We've got a whole bunch of AI tools that can alert people like the real-time crime center, be able to dispatch a drone immediately. So the reason we made not just one acquisition in this space, but two, is because we now have the most modern technology stack for handling 911 calls. Our second acquisition actually not only layers in AI, but can replace the entire call center. You can run it from the cloud. And so that means, you're not stuck on an old tech stack. We can move your entire tech stack to the speed of, modern technology.
Now, what's the reception? I am sure that some of these different police departments are a little bit hidebound, might not want to try this. How are you convincing them?
Oh, man. So we'll point them to, we had one major city this past summer that deployed Prepared 911 right before a holiday weekend. And what did they see? Even though call volumes normally spike, and their call volumes did spike, the number of calls that operators had to handle dropped 33% because AI was able to take on all the non-critical calls, like a noise complaint. Look, you don't need a human operator during a busy weekend taking noise complaints. AI can do that. So we're seeing tremendous interest from our customers. We just made the announcement of the second acquisition yesterday. I can tell you, the thing I focus on is customer reaction, and they're seeing that this is our opportunity to come in and totally disrupt the whole mission-critical voice space.
All right. So one last thing, the massive market opportunity slide, $159 billion, against what I heard on a Motorola call, Motorola Solutions, last time they spoke, where they say they now have a product that can compete with yours, SVX, the AI-driven assistant, and that they are starting to win business from you. Now, you are a competitive guy. What should I do with this Motorola conference call, which says, listen, we are in to win against Axon?
Well, Motorola won the RCMP, I think, last year. And the RCMP actually tested the tech and then ultimately canceled it and came to us. So, we don't spend any time focused on our competitors. We focused on winning in the hands of the customer. And, when we do that, things work out. So I'm confident we have the best tech stack in the industry. And, the fact our competitors spend a lot of time talking about us, is an indicator to me we're focused on the right things.
All right, that's the most appropriate answer imaginable. Rick Smith, Axon founder and CEO. Thank you for coming on, Rick. You always do, and I appreciate it.
Thanks, Jim.
I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow. Thank you, Harvard Business School.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.